So, let's talk about the Cardano ecosystem. Lately, it's been showing some serious signs of life, just firing on all cylinders. Today, we're going to take a look at its explosive growth, see how it's actually generating real-world returns, and maybe, most importantly, see how it held up during a huge market-wide stress test. Let's get right into it.
I want to start with just one number, 85%. Now, in the cutthroat world of decentralized finance, a number this big has to mean something. What could it possibly be? Market share? A surge in users? Whatever it is, it's a huge sign of momentum.
All right, so that 85%, it's all about trading volume, and we're going to unpack that in just a second. But first, here's the plan. We'll kick things off with that explosive DeFi growth. Then we'll dive into how projects are building actual real-world yield. After that, we'll look at a massive stress test the ecosystem just went through, see how it's funding its own next wave of ideas, and finally, look at how it's expanding its horizons.
Okay, let's jump right into part 1, DeFi's explosive growth. This is where we get into the raw numbers and see the proof of this recent surge in activity.
And there it is, the answer to our 85% mystery. It all belongs to a single platform, Strike Finance, which is a protocol for trading derivatives. Get this, in just a 24-hour period, it captured a whopping 85% of all trading volume on Cardano, hitting a new personal best of $12 million in daily volume. I mean, wow, that's not just growth, that's straight-up market dominance. So a ton of volume is great for the platform, but what does that mean for you, the user? Well, take a look at FluxPoint Studios. In just the next 30 days, they're projecting over 8 million agent tokens will be paid out as rewards to their stakers. This shows that all this activity isn't just numbers on a screen. It translates directly into real rewards in people's pockets.
But what's really cool? None of this is happening in a silo. These projects are actually building on top of each other's success. You've got Pulse teaming up with Optim and Surf to create totally new yield markets. At the same time, Surf has become one of the biggest holders of the SNEK token in the world. Then there's Fluid tokens, bringing in millions of new value while testing new Oracle tech. And Wisdom is even creating a free course to help get more people using Strike Finance. What you're seeing here is a deeply connected ecosystem, where a win for one is a win for all.
So let's move on and see how this all connects. We're going to shift gears a little bit, moving from the purely digital world of DeFi to the nuts and bolts, the physical infrastructure that's generating real, tangible returns for token holders. A perfect example of this is Titans. They just launched a new rewards calculator. On the surface, it's a super simple, user-friendly tool to help you estimate your annual returns. But what's really fascinating is what's going on behind the scenes, the complex, real-world operation that actually generates those rewards in the first place.
And here's that behind-the-scenes look. This is the Bertha mining facility. And look at the transparency here. The team openly shared that a control panel issue took the facility offline, and they even gave a specific date for when the engineer was coming to fix it. This is the gritty reality of running physical hardware, but the payoff is huge. They're expecting a 2.5 times boost in Bitcoin output once it's back online, and they're already planning a second facility.
And to make it even more real, check out this breakdown from NecroLeague's mining operation in September. You can see it all laid out. The gross earnings from mining different coins, the real-world operational costs like electricity, and then the final profit that gets paid out to their NFT holders. The bottom line, an APR of around 34%. This is what real yield actually looks like. It's transparent, it's verifiable, and it's profitable.
And hey, this isn't just a one-off thing. This chart puts the scale of these community rewards into perspective. You've got Angel Finance, which has paid out over 775,000 ADA so far. That shows long-term consistency. And then you have projects like Hoskilien and NecroLeague delivering thousands in just the last month. This is a real widespread trend.
Okay, so growth is great, yield is fantastic, but how does the whole system hold up when things go sideways? And that brings us to the real heart of our story today, the ecosystem stress test. This was a real-world showdown between a protocol called Indigo and a massive market-wide flash crash. So picture this. It's October 10th, and the entire crypto market just gets hammered by a flash crash. In the middle of this chaos, a data feed, an oracle, that Indigo Protocol uses suddenly reported a crazy low price for ADA, down to around 45 cents. Now that price was wrong, but it stayed that way for about 2 minutes, which was just long enough for the protocol's automated systems to kick in and start triggering liquidations. So what exactly was at risk here? Well, these things called collateralized debt positions, or CDPs. Just think of them as loans where you lock up your crypto as collateral. When that faulty oracle screamed that the value of the collateral had tanked, the protocol's automated systems did exactly what they were programmed to do. They started selling off that collateral to cover the debt.
And here's the hard data from the event. You can see the protocol just went to work, absorbing hundreds of thousands of ADA and collateral and burning the synthetic assets tied to it, IUSD, IBTC, you name it, all to keep the system stable. This was the system working exactly as designed, but under the most extreme pressure.
So what do we make of all this? Indigo's post-mortem on the event is incredibly revealing. On one hand, the protocol itself was totally stable. There was no systemic failure, and every single action was transparent on the blockchain. On the other hand, they identified clear areas to improve, like making their liquidation bots more efficient and figuring out better ways to handle network congestion. The point is, this wasn't a failure. It was a successful stress test that proved the system was tough, and it gave them a roadmap for how to make it even tougher.
Proving you can take a punch is one thing, but how do you make sure you keep growing and innovating for the future? That brings us to our next section, funding the next wave. We're going to look at how the community's own treasury, Project Catalyst, is fueling the next generation of builders.
And check this out. 2 proposals from the Wingriders team just got funded. They're building a brand new, high-speed decentralized exchange and a universal launchpad to make it way easier for other projects to deploy their own tokens. I mean, these are fundamental open-source tools that are going to lift up the entire DeFi space on Cardano.
And it's not just about DeFi. A project called Masumi AI also just got its funding to build out a decentralized AI agent network. This really shows the diversity of ideas getting support. And their goal? It's pretty ambitious. They want to make Cardano the actual backbone for the entire decentralized agent economy.
So the ecosystem is growing from the inside, and it's funding itself. But what about looking outward? Let's get to our final section, expanding the horizon. This is where we see projects making strategic partnerships to really drive that long-term mainstream adoption.
This slide really shows you the kind of forward-thinking ambition we're talking about. You've got Dedium partnering up with AetherCloud to scale decentralized computing power. You have Trifecta going after government and school contracts to get institutional users. And then you have Fluid Tokens exploring this wild new idea of staking Bitcoin directly with miners. These are big strategic plays for the future.
So, if there's one thing to take away from all this, it's that the Cardano ecosystem is clearly maturing. It's really moving past the hype and proving that it can generate real, sustainable yield, that it can withstand major market shocks, and that it can strategically fund its own diverse and ambitious future.
Which really just leaves us with one final question. We've seen the growth, we've seen the real-world infrastructure, we've seen the resilience, and we've seen the pipeline of innovation. The system is proving itself time and again. So the only question left is, where will the next big breakthrough come from?